Rising interest rates in New Zealand have hit our stock market today as our own authorities warn banks and home buyers about the impact of such rate rises here in the future. Our business editor Ross Greenwood joins us. Ross, first to New Zealand, was the rate rise from the Reserve Bank of New Zealand expected?
Well, it was kind of expected, I would have to say. So New Zealand has become the third country after Norway and Korea to increase interest rates after coronavirus. So this increase has come 0.25%. It's now to 0.5%. And in its statement, the Reserve Bank of New Zealand basically points to inflation. It says that it's the right time to take away this stimulus of these record low interest rates. It also believes that its inflation rate is going to rise to 4%. One important aspect of this is it says that as vaccination rates increase in New Zealand, it's going to take away the economic impact of any sort of outbreaks that might occur into the future. And so it really expects its economy to start really motoring along, and that's going to fuel that inflation in the short term. That's the reason why these interest rates have been raised by the New Zealand Reserve Bank today. Of course, noting that the Australian Reserve Bank yesterday made no such move. Indeed, has said right at the beginning of this year that it'll be 3 years before interest rates move anywhere here in Australia.
Yeah, so what should our viewers be reading into this? Does it have a parallel here today with the bank regulator APRA curbing the amount that people can actually borrow when they try to buy a home?
Well, 100% it does, because the Reserve Bank told everybody in Australia, if interest rates aren't going anywhere, they're going to beat these record lows for 3%. Everybody went, yahoo, let's go and buy a house. And as a result, pushed house prices up, particularly in the major capital cities. Now, a shortage of supply also has meant that those house prices have continued to rise. And now banking regulators in Australia are starting to get a little nervy about the amount of money that Australians are borrowing. And so the changes that have come in today from APRA, the banking regulator, effectively say that they're going to measure you and your ability to repay that loan at 3 percentage points above the interest rate you're paying. So if you borrow at 2%, they're going to assess you at 5% rather than assessing you at 4.5% as they were previously. They're also open to other steps. Now, as much as anything else, APRA is trying to protect the banking system from any collapse. But APRA today made this statement. This is the interesting one. A 50 basis point increase in serviceability buffer will reduce the maximum borrowing capacity for a typical borrower by around 5%. So the average mortgage in Australia, and I can show you this, is around $580,000. More in Sydney, more in Melbourne, less in other parts of the country. And so if the average mortgage is $580,000 and APRA says your borrowing capacity at the maximum is going to be reduced by 5%, that means your new borrowing capacity, the amount the bank might offer you, is $551,000. So in this example, around about $30,000 less a person might be offered by their bank now as compared with what it was in the past. We've reached out to the Treasurer, Josh Frydenberg, today. Of course, is in lockdown, but this statement's come from the Treasurer saying we must be mindful of the balance between credit and income growth to prevent the build-up of future risks in the financial system. So that's what this move by APRA is about today, to reduce risk in the financial system. And remember also, the other problem at the moment is that credit growth is growing faster than income growth. So in other words, people are taking on debts much faster than their own increase in salaries and wages is taking place.
Ross, more broadly, there are some other worries in the financial system as well, aren't there? I mean, we're hearing a lot out of China about the ongoing concerns regarding that property development giant Evergrande. What's the latest on that?
Well, OK, so the shares in Evergrande are suspended because the expectation is that they're going to sell off their property management business for about $5 billion. Now, in that particular case, the $5 billion is not really going to be enough because you can see here the outstanding interest payments. It'll help out a lot, but remember the debt's due some 300 billion Australian dollars. But if we run through some of these, sort of, if you like, debt payments that are due, $47 million, well, that's been missed. There's another outstanding payment due, 3 of them on October the 12th, and then it keeps on going, some $566 million is due just until the end of December, according to Reuters. So, you know, the $5 billion, if they raise that, effectively is going to be a bailing out of Evergrande. It's not the only company in China right now. There's another one called Fantasia, which also has missed interest payments. And so this is now a real worry because it would not only affect the housing sector, many people would lose money if they put deposits down with these companies. But then the second part about it is apparently they're treating bondholders in China quite differently to international, global bondholders who might be in other parts of the world. In other words, they're not paying the global bondholders quietly. They're finding ways to be able to try and pay off those people locally in China who are owed money by these companies.
Gosh, and there's such huge numbers we're talking about. It is a bit of a worry. Ross Greenwood, appreciate you explaining it all to us. Thank you so much for your time.
Quite okay, Ash.